This past Thursday, on November 29th, a worthwhile, valuable discussion about cryptocurrencies, blockchain, and related topics took place between noted New York Times financial reporter Andrew Ross Sorkin and the current chairman of the Securities and Exchange Commission, Jay Clayton. Why these highlights from this New York Times Dealbook talk are important is not that it made any new news about the subjects, but rather it confirmed at the highest level of government decision-making that cryptocurrencies and the technology of blockchain are not a fad and are clearly here to stay. More specifically, the chairman of the SEC here confirms the legitimacy of ICOs, initial coin offerings, and that although there is no final decision yet, they may well continue to be treated for now by the U.S. government regulators as private currencies, not securities, which is certainly Jay Clayton's view, which means they will be far more lightly regulated, which also confirms the riskiness of crypto coins as well. More importantly, there is even more reason that all companies, especially new ventures, factor in crypto and blockchain into their future. While neither are ready for prime time yet, they will be. The only question is when. Now, here are the highlights of Andrew Ross Sorkin and Jay Clayton discussing cryptocurrencies, blockchain, and related topics.
Executive Creative Director for the New York Times live event series Times Talks. Tonight we're thrilled to present our first ever Times Talks Dealbook event on one of the most important technological innovations in business, blockchain. I want to give special thanks to tonight's sponsor, Accenture. We are very pleased to present one of the leading experts on blockchain, the chairman of the Securities and Exchange Commission, Jay Clayton. Since taking office in May 2017, Chairman Clayton has been outspoken on securities laws issues related to distributed ledger technology, cryptocurrencies, and initial coin offerings. Moderating tonight's event is Andrew Ross Sorkin, New York Times columnist and founder and editor-at-large of Dealbook. He is also a co-anchor of CNBC's Squawk Box and the author of the best-selling book, Too Big to Fail: The Inside Story of How Wall Street and Washington Fought to Save the Financial System and Themselves, reissued this fall on the 10th anniversary of the 2008 financial crash. Be sure to pick up your own complimentary signed copy of Too Big to Fail following tonight's event, courtesy of Accenture. Please join me in giving a warm welcome to our moderator, Andrew Ross Sorkin, and our special guest, SEC Commissioner Jay Clayton.
Chair Clayton, thank you for being here.
Thank you.
It's a privilege to be here with you. I should say I knew Chair Clayton when he was Jay about 10 years ago.
I'm still Jay.
You're still Jay.
Still Jay.
In the midst of the financial crisis, and 10 years later we have come quite far. We want to have really a wide-ranging conversation tonight, and I should say we want to make this as interactive as possible, so we'll open up later in the conversation to all of you who I know have so many questions. We have framed this around this concept of the blockchain and crypto, and I would make an argument that a lot of that came out of the financial crisis 10 years ago and some of the trust and distrust questions that arose. And let me start here though, and then on the crypto front. Because there are, every single day these days there's questions about the blockchain, there's questions about Bitcoin, you see the price going up and down and this and that. My question for you is, and one of the reasons I wanted to have you here tonight is, to me, whether you believe it or not, you actually may be the swing vote, if you will, in the future of so much of this technology and how it gets enabled or not, in terms of what the regulatory framework looks like. And so the question I was going to ask is, when did you start even learning about this stuff? Because all of us, so many of us, are still learning about it.
Wow. So let me respond to the swing vote, because I want to give you perspective on how I look at things from the SEC's perspective. Our job is not to vote. Our job is to present an even playing field on which other people vote, whether it's the price of a security or not, and to provide a forum where there's disclosure. And that is truly how I looked at this technology in terms of its effect on the securities market. So that's kind of the perspective, but I appreciate that you want, we want to be fair arbiters of the market rules, and that's how we approach it. But in terms of this technology, let me give you an anecdote. My confirmation hearing, and no confirmation hearing is pleasant because they can ask you absolutely anything. And there were a number of questions. The questions for the hearing was a couple of hours, maybe 3 hours, and the questions went on for a long time. If you search the hearing transcript and all of the questions, you won't find blockchain, distributed ledger technology, Bitcoin, Ethereum. Not a single question in March of 2017. By July,
Were you prepared for questions?
I was prepared to say, I'm thinking about it. Which is a good answer to most of those questions.
So what did you do afterwards?
And I can tell you that by July, it was very good. And I was just trying to educate myself on how people thought of this in terms of our securities markets.
And did you have any initial inclinations about the future of what these things were and were supposed to be? Because even then, by the way, I think people like Warren Buffett were out there calling some of this rat poison squared. And then on the other hand, there were people who were saying this was the absolute future.
And that's why I thought I better figure out, why you have Warren Buffett saying what he's saying, others saying what they're saying. And I shouldn't say just there were a number of people at the commission, and I'm very proud of them, who pivoted quickly away from what they were otherwise doing to say, well, how does this new technology fit with the way we approach our securities markets?
So where have you landed? And I'm not sure that you've landed, I don't know if you feel like you've landed anywhere yet, or there's still a lot of work that has to be done.
Well, where I've landed is that our rules and we have kind of two rule sets in the securities markets. One is for the offering and sale of securities, and the other is for trading of securities. And my view is that our rules have stood the test of time very well, and we should not change them to adapt to technology. Technology ought to be able to fit within our rules. And I think this technology has incredible promise for adding efficiency to our marketplace, but I'm not going to change the investor protection aspects of those offering rules or those trading rules just because there's a new technology.
Okay, but just take me on the journey. I just want to understand it because I think so many people who are here who are interested in this topic are trying to figure out, people look at Bitcoin, for example, and then there's the question of, is it a currency?
Mm-hmm.
Is it a commodity? Is it a security? What is it? And I just want to get inside your brain to understand sort of how you've been thinking about it.
So let's start with what's a security, and the folks who came out of the crash and crafted our securities laws, women and men, geniuses, because they understood.
You're talking about the crash in 1929.
The 1929 crash, but they were geniuses. They understood that. Here's the fundamental thing. If you're going out broadly and you're saying to people you don't know, give me your money, I'll give you a stock certificate, or I'll give you an investment contract, or I'll give you a warehouse receipt, or I'll give you a token. I don't really know you, but I'll give you that, and you're expecting to get some kind of return from that based on my efforts. That's a security, and we need to regulate it, because that distant relationship and that money changing hands, it's ripe for fraud. It's ripe for abuse. And that's what gave rise to our securities laws. And so we said, if you're doing a public offering in that kind of context where I'm raising money from you and all these people, you got to go through disclosure rules, you got to have financial statements, and that has, look, we've created a $20 trillion economy following those rules.
You used an example recently where you compared the raising of money using an ICO, effectively, to the equivalent of starting a Broadway production and effectively pre-selling tickets.
Yeah, let me, and it goes to your question of when do the securities laws apply? And when has an asset become so distributed, so disaggregated, so out of the control of one person that the securities laws no longer apply and it looks more like a currency? So the analogy I gave was, Andrew, you're gonna start a production. You go out to a bunch of people and you say, give me your money. Production hasn't got off the ground. Don't worry, I know actors, I know other people, I'm gonna get this going. And what I'm gonna do is I'm gonna give you a ticket or a token in exchange for the money that they give you. That sure sounds like a securities offering, okay? But you get the play up and running, you're done, all the tickets for the next few years have been distributed, they're broadly, you don't control, you're no longer, growing the business exists, and then they trade free. And that's kind of the concept of our securities laws. And if you ask why do we look at Bitcoin as not securities transactions,
right,
it's widely distributed. It was not controlled by a single entity or other people. It's used as a medium of exchange. You're not looking to the efforts of others to increase your return, and that's why. So it looks much more like a currency than a security.
And how would you differentiate that from a commodity?
Well, commodities like gold, silver,
right?
They generally have a use other than a medium of exchange.
And you don't think? I mean, there's some people who just say this is liquid gold, though, for example.
Well, I think they say it's akin to that.
Right.
But you do have an industrial use for gold, you do have an industrial use for cocoa, you do have an industrial use for sugar or grains or other commodities.
And you think that is that's the distinction?
I think it's closer. Now, people do think it's a commodity, but I'm not speaking legally tonight. I'm trying to speak colloquial. That's how we see it.
Well, let me ask you a different question. It just relates to this, though. But it relates to market psychology. So the other thing that's happened during this whole
it's like a currency.
It's like a currency,
right? I mean, it doesn't have a sovereign backing, so it's different from a sovereign currency, but it's designed as a medium of exchange.
Are you a believer? So some people say, Christine Lagarde
and to be clear, I'm not speaking for the CFTC tonight.
Well, okay.
I'm not speaking for the SEC, I'm speaking for something, I'm definitely not speaking for the CFTC.
So let me ask you different. So really, Christine Lagarde came out publicly and said that she could see a time when cryptocurrencies were backed effectively by governments, right? That this could become the future. And so one of the things that I think people wonder about is, if something like that were to ultimately happen, would that be validating of all of these new forms of currency, whether it's Bitcoin or Ethereum or any of these other kinds of things? Or would you think that would ultimately crowd out these things because you finally have a regulated version of this?
I think we'll see.
Good answer. By the way, I have questions about your answers. Because I was thinking about the other Jay, Jay Powell, and how everything he says, literally the word, the comma, is interpreted by the public and the markets down to the nth degree. Do you feel the same way? I mean, just now that I've known you for 10 years, we haven't gotten a real chance to actually talk much since you actually got into this role. I'm actually sort of curious as a person, how that's changed for you.
Well, I think we all at the commission try not to comment on things that would move markets, whether it's a particular security or markets generally. I think Jay does a great job because he knows that his comments are followed by people in the markets. I think that's a really significant responsibility that he has. I try to stay away from anything that's going to. I won't comment on a particular company or a particular stock. It's just not appropriate for me to do so.
Okay, so let me ask you this, and it does relate. We use Bitcoin, but we'll use it as a proxy for this portion of the conversation. Because you do think about markets, and you think about the public and public shareholders and investors and the public at large. How do you think the both bubble up of Bitcoin and the price and the hysteria around that, and the drop down over the past 12 months has affected market psychology and trust? Because this goes, it's funny, Bitcoin and so many of these distributed kinds of cryptocurrencies were ultimately about sort of creating this sense of distributed trust, but in some ways, some of that trust has become undermined, and I wonder how correlated or uncorrelated that is to the markets, and also just to the broader sense of public investor interest in any of these things, and how much you think about that.
Well, let me say how I think about it, but it's also how I think the people at the commission think about these things. Look, the markets have a lot of sophisticated players, a lot of complexity, literally hundreds of millions of transactions a day. But at the end of the day, we're running these markets for the long-term retail investor, whether indirectly or directly. I mean, our capital market system should be run for those folks. The people who are putting $100 a month, $200 a month into their 401k for 30 years. It's their money, their long-term money, that fuels all of this. So, when something like this happens, the lens at the commission is, how do we deal with this with those people in mind? And I can tell you that, very quickly with crypto assets, we tried to get the word out that although the trading looks like the trading you would see on NASDAQ or on the New York Stock Exchange, these markets do not have the same kind of safeguards for you. We've worked for 50, 60, 70 years to try and prevent manipulation in those markets, to try and prevent people from taking advantage of the small player. It's what we do, but the markets that these things originally traded on, they didn't have those safeguards. And I made it also clear to people that if you're sending your money offshore and something goes wrong, there's very little we can do to get it back as a practical matter.
Well, so let me ask you about that.
And I hope people heeded that. I hope they didn't use their credit card to buy some kind of offshore token without really, really, really thinking about it.
What do you think has to happen from your vantage point for a Bitcoin or an Ethereum to actually be a regulated, or whether you think it's well, I imagine you think it ultimately has to be regulated. What would have to happen? Give me your sort of 5 years out, what's supposed to happen if this is supposed to be a real thing?
Look, I think what is the use case? What's the permanent use case for anything, right? That's how you look at an investment.
That would suggest that actually 5 years from now we wouldn't necessarily be talking about this, because we just talked about how a commodity, we could say, is a real thing. Unless you're saying you think you're.
You asked me where something is in the future. Okay, I'm going to be philosophical with you.
Okay.
Okay. Well, I think you know that I love markets. You know that I love ingenuity. One of the I'm not going to take credit for this. But one of the wonderful things about America is, if there's a new technology, we pour an incredible amount of energy and capital into it. And it's a race to figure out what the best use for that technology is. And there are lots of failures and there's some successes, but anybody who predicts with certainty where that race is going to end and who is going to emerge, I want to meet them.
So where do you put this space? And but I guess what I am asking though is, in terms of, if you were an investor thinking about this space, the crypto space, and specifically the currency space, let's call it for now, let's take ICOs out of it for a second. What do you think has to happen for it to become truly a popularized, and by the way, I'll turn it around. If the Winklevoss twins, for example, wanted to have an ETF based on some of this stuff, it would be back in your space.
That's true. That's true. And that's a different conversation that we can have. And I just don't know where it goes. But going back to what we started with, I want to try and be clear and fair and apply our rules to this new technology in a way where we're not picking winners and losers, but we're protecting investors.
Let me ask you a different question than around blockchain, the technology, because I've seen you make lots of comments about, on the infrastructure side, how you think that's actually going to be a very important component of the future of business.
Well, going back to your question on trust, One of the promises of this technology is that it adds efficiency to the trust issue. So like, you know, we have government records and we spend a lot of money, you know, recording and making sure that they're accurate and that they're immutable and all of those kinds of things. And this technology has great promise to deal with
What do you
that.
think of the idea that so much of this technology ultimately is actually about not only being distributed, but actually having no real arbiter? The arbiter, if you will, if you really understand the philosophical underpinnings of much of this technology, is that there is no arbiter, there is no judge, there is no jury. Everybody who's participating is that. And that one of the reasons it actually hasn't taken off.
That's a real issue, okay? Because if you look at our securities laws, I'm getting more, and I'm staying in that space, but I'm getting more sophisticated. They do assign responsibility. A company has to produce financial statements. They have to produce disclosure. If they don't produce it, they have a problem. If it's materially inaccurate, they have a problem. If you have an investment bank that acts as an underwriter and, you know, there's a problem, they're responsible. Accountants, they have responsibilities. We've set up this system of responsibilities. We always take it for granted, but there are people who have responsibilities. If you're going to distribute an ecosystem and say, you know, no one has any responsibility if something goes wrong, well, heck, nothing better go wrong.
Do you think, and I think it was just earlier this fall, maybe in September, I think Congress sent you a letter saying how should all of this be regulated. Do you think that Congress will ultimately have to create new laws for this world?
I think we'll see. I think the securities laws do well in securities offerings. I think my friends at the CFTC feel comfortable with their laws to the extent we have digital assets that don't fall within either, and they begin to have you know, substantial use, maybe. But there are laws that apply to crypto assets that go beyond the securities and commodities laws, including, you know, anti-money laundering laws,
Right.
and, you know, terrorist financing laws and all of those kinds of things. You know, there are other laws that apply. Go ahead.
I was going to say, you mentioned the CFTC, and one of the things that, and it almost feels like sometimes the SEC gets pitted against the CFTC in this regard. The CFTC has been very aggressive about being behind, or maybe ahead, I should say, in terms of being, I don't want to say promote crypto, but yes, I would argue that they've sort of gotten behind this in a real way. Do you feel any kind of competition between the groups?
Actually,
do you guys have conversations about this stuff?
oh yeah, no, I feel very good in this job that I can pick up the phone and call Christian Carlo at the CFTC, or, you know, call Randy Quarles or Jay Powell at the Fed, or Joseph Otting, or folks at the Treasury, if there's something like that I feel like, you know, there's an inconsistency in the way we're approaching things.
I do this because it does relate to sort of the advent of ICOs, but ICO is.
I will say it this way. Assume an offering of securities that is styled as a token or coin offering.
And I think it relates to a larger issue in this country right now, which is that so many entrepreneurs out there say they don't want to be a publicly traded company, or they don't want to go through the ordinary publicly traded process, if you will. This is James Freeman. He was the founder of Blue Bottle Coffee. I don't know if you saw this. He sold his company to Nestle, and when he was asked why he didn't pursue an IPO, he said that he thought an IPO seems like a way of living in hell without dying. And I thought that was sort of a fascinating way to think about it. I think it speaks to the crypto thing, but I think it speaks to a larger issue in the marketplace today, and I want to know how you thought about that right now.
He's, you know, look, he struck a chord, and he's not the only one who feels that way. And the numbers don't lie. We've gone from 8,400 public companies to just over 4,000. The size of company that you see entering the market is much larger. Companies would go public much earlier in their cycle. I believe there are multiple contributing factors to this, but we need to look at them. And one of them is, are we, I'll try and give you these stats. I think I know them. Top company in the S&P 500, and like the 100th company is, it's 40 times less. Then we go to like, halfway down the S&P 500, we're at like 100 times less the size, and it gets down to 200. You got 1/200th. You probably should not regulate 1/200th, much less 1/1000th of the size company the way you do regulate the top company. I think that's, we need to think about that a little bit. Another metric I like to think about is, you've got a decent sized company, well run, and it's a public company, and how much time in a quarter does the management spend on compliance and dealing with regulation and performing that function? It's probably somewhere between 20 and 30 days out of the 90. Or maybe it's 15 in a place that's doing it very efficiently. If you look at a similarly sized private company, that number is probably 2, 3, 4, 5 days. Well, think about that in terms of competitive advantage for the private company. They've got, another 20 days, 15 days where management can be devoted to the business versus compliance. I ask myself, can we fix that without in any way impairing investor protection?
So you ask yourself that, and how do you answer the question?
Well, we're working on it. We have a regulatory agenda that we're trying to get rid of the things that we require companies to do that don't go to investor protection and that don't go to material information. And we're looking at that. Look, our securities laws have been so successful. I mean, there's problems, but they've been so successful at contributing to this economy, and they're so effective. Like, if we tell a company, you've got to disclose this, they usually do. I mean, think about that. And so people have used that to add things to our securities laws over time without in any way taking something away. So I'm trying to look at it and say, are there things we can do to streamline this, making sure we're not doing anything to take away and hopefully enhance what we give to investors, but reduce the burden.
Did the size of the company matter to you? Meaning you were talking about how there might be certain types of regulations that matter for a large company, but that you don't think then should be applicable?
I mean, I'll just, look, I'm again, speaking of myself, but you have a multinational company that has a number of subsidiaries. The kind of, what I would say is compliance and reporting process that you should go through on that company should look far different from a monoline company that only has operations, in the Midwest. The threshold for disclosure is this a material event for the business? And that's the general threshold. Is this something that we think is going to affect our business in a significant way? Yep.
President Trump tweeted earlier this year, and then I believe sent you a letter directing the agency to look into how to create companies, or how to push companies to think more long-term. In fact, he had this idea, I think he was whispered in the ear by Indra Nooyi from PepsiCo at the time, who recently stepped down as the CEO of that company, that maybe they should only have earnings reports twice a year. And I know you're looking at this as an issue.
Okay,
What's happening?
So look, the president, I think he struck a chord, and he said something that I think is important, which is if companies are being run too much for the short term, that's not a good idea, right? Most investment cycles for a company are 3, 5, 7 years. You're hiring with the expectation that the people will work there for a while. You're investing in plant, property, equipment with the intellectual property with the expectation of this for a while, and running your company quarter to quarter to the exclusion of that, not a good idea. That said, our markets thirst for information. They thirst for quarterly information. all credit agreements require quarterly information.
So what's the right balance?
So the question is, how do you get people comfortable looking beyond the quarter as investors? Easy question to articulate, hard in practice. One of the things that's interesting about our disclosure system, is it's a backward-looking disclosure system. When you report last quarter's earnings, you talk about how you did, and the outlook section, or the outlook part of reporting, is generally fairly narrow. It's the way it's evolved over time, and those that quarterly guidance that some people do, and that's up to them whether they do it or not, that becomes a very important number because it's sort of one of the few forward-looking data points. The question is, how do you encourage people to look beyond that one quarterly data?
But then this goes back to people, by the way, with their ICOs, and they're trying to sell you on the future. How do you actually tell people? Almost suggesting that actually we should have more forward-looking guidance.
Or more forward-looking information, but back in my lawyer days, I will tell you that everyone was always cautious about giving too much forward-looking information for fear of liability.
For fear of liability and for fear of for fear that your guidance is going to turn out to be wrong.
Yes.
So what's the answer there?
I think I'm not going to. There are companies that are very good. There are companies that are very good at charting a direction, updating that direction, and getting investors comfortable with that longer-term direction and their ability to achieve it. And I hope that the way we regulate companies encourages that kind of shareholder communication for the longer term. And I am looking for suggestions on how to amend, change our system so that we can foster that kind of conversation in a way that provides investors with better disclosure